Well, the Fed minutes were conclusively hawkish, with the majority of members coming out and saying they vote for another rate hike. Should the domestic situation in the U.S. improve economically? But that goes against what Yellen said earlier, which was that they're not going to be able to raise rates at all. Their hands are tied as long as the global economy remains in a funk. And so far, the global economy is in pretty bad shape. So I think, it's a lot of Fed jawboning going on, as they normally do. They have to give the appearance that they're on the ball here in terms of wanting to hike rates again, but maybe with no intention to do so, as long as the global economy remains bad. The situation doesn't seem to be improving abroad. And even domestically, I mean, there's too much anecdotal and anecdotal evidence, but even more pronounced evidence that these statistics are heavily doctored, and that there's a lot of issues going on in the States that often get suppressed by the major media. Fortunately for the internet, the presence of the internet, we see a lot of information leaks, a lot of whistleblowers. There's a lot of hurt and pain going on, not just in other parts of the world, but also in the U.S. And these statistics are pretty startling, but when you start to do your due diligence and looking into each issue at a deeper level, you can start connecting the dots and seeing that that things are definitely not okay in the States. So I think that obviously the markets normally would be a reflection of that, but when you're manipulating the markets as hard as the Fed has done and the central banks around the world has done to prop them higher, you mask it. And that's, I think, the markets manipulation is a microcosm of the bigger picture in terms of information flow, controlling information. And this is nothing new. I mean, this has been done for millenniums, since the dawn of the printing press, certainly. And in the meantime, we have to just watch the market like a Zen Buddhist in real time, and as the data comes to us, we take action on the short or the long side. I mean, ultimately, what we're here to do is to make money. I wouldn't be worried. It's not good to be worried about the state of things globally. And I would just say, let's focus on the matter at hand, which is the MDM market direction model has been on a sell signal since the 3rd of May, and the VVM is looking for low-risk situations where it can catch maybe a short trade or maybe something longer. Generally, on the short side, when VVM goes on a buy signal, it's betting that the market's going to go lower, and those signals tend to be pretty short-lived because, as we know, the markets tend to go down in a hurry. And whereas when they're on an uptrend, they tend to take the stairs, so they tend to have a more concerted, steady approach to almost baby-stepping approach to moving higher. We put out a number of short updates out there. They seem to be doing well. On the long side, there have not been too many names naturally because the market's been in a downtrend for a number of weeks. And that said, as I pointed out, the model, whether the models are on bullish or bearish signals, is irrelevant to the action of individual stocks. And so, it's only relevant in the sense that if the market is going higher and your stock is not rallying with the market, that's an important signal, and vice versa. So, contextually speaking, it's important, but the model signals in and of themselves are for the models, and there's often, may not be much correlation in terms of, say, the MDM being on a buy and a stock that's really showing some difficulty that is setting up just perfectly for a short sale. So always keep that in mind. Now, as far as commodities, oil, and those things, those instruments seem to be going higher. They've been in an uptrend for quite some time, since February when the market bottomed. And it's possible that this uptrend will continue. It's possible also that, keep in mind that with rates so low and all this money sloshing around, that the QE engine will put in a shallow floor of sorts for the markets, and then they'll, who knows, maybe we're going to start to slingshot higher again, like we've done for the last 7 years. It's been that long. This bull market is about as old as they come, but you got to throw historical facts out the window, because in this particular instance, it's completely laden with quantitative easing manipulation. So it takes a lot of those old facts and makes them null and void. So it doesn't matter if the market did something 10 times out of 10 in the past. This is the 11th time, and the market's already shown that this time is different in various ways. So, you know, I wouldn't get too tied up in historical facts in terms of letting that guide your decision making. You got to look at the market on a day-to-day basis, which is what we do in terms of going long or short, and then of course taking profits where you have them, or cutting your losses short. And that's especially important for a model like the VIX volatility model, which it depends on the big. It has lots of false signals, but when it can do well, and there's plenty of times where it does, that more than makes up for those small losses. So in terms of guiding your own trading, I think it's just a good method anyway, especially in these QE years, where we're not getting the type of uptrends that we saw plentifully in the 90s. But at any rate, I'll turn it over to Gil. I'm sure he has plenty of things to say on the short side of the market.
Yeah, I think, Dr. K, you made the point that the market's been in a bull market for a long time, and of course we see back here on the NASDAQ chart, hopefully you guys can see this, you have the low way back here in the early part of 2009, and it's continued to truck higher, and it's starting to get very volatile. I mean, you can see some major swings in here that shows somewhat of a change of character. I mean, some of it's due to it's not arithmetic, but you're still getting these huge swings in the market, and it's starting to look a little funky up at the top. And if you look at this, you could argue that we're building a big top, and that's kind of what it feels like. But I still think the market's really a situation of being able to go long and short and moving in rapid fashion by taking advantage of the market's inherent volatility. So, I mean, I would say the only reason I'm up this year as much as I am is because of the fact that I've been very rapid fire in my approach. I'm not even holding stocks for more than a week at times. I'm holding them for a couple, 3 days at most. And sometimes they're day trades, and it's become like that, I think. You know, just as everybody figures out that this is a swing trading market that you can now sell a swing trading product for, and you're going to make a ton of money doing that, the market time frame compresses even more, and it becomes funkier. I mean, yesterday was very bizarre. The movements on an intraday basis were pretty bizarre as we saw everything just flying around. Getting the stocks, we sent out an array of short sale ideas, and some of them were repeats of other names we've talked about, such as Microsoft, which yesterday it ran right into the 50-day line, so it's a short there. And you see, in this case, you don't try to figure out what the market's going to do. What you do is you see the setup and you go for it. And I'll give you an example of the opposite case. Yesterday I saw this cyber setting up tight. It actually had a very subtle pocket pivot, and you could have bought it there, and or even bought it this morning, and the stock's up 2.5%, 2.25% right now in a down tape. So you could probably trade that to the highs of the range and then bail, and that's sort of what you get. You know, look at NVIDIA. This stock was even continuing higher today, but it's starting to run out of gas. You know, last week we also looked at Activision, which continued higher, and it's running out of gas. But again, as I pointed out last week, these things are coming up to the highs of big cup type formations, so they could be, in ATVI's case, could be suspect. Electronic Arts also a nice gap up, it moved higher, but it's run out of gas, so it's probably headed for the 10-day. I would keep some names on my buy watch list as they're pulling back, because I think you need to be ready for anything. If the market's selling off, and Dr. K, would you agree that the market's probably selling off because of the Fed getting aggressive? We were talking about this earlier, and starting to really talk about raising rates. You think so?
Yeah, I think that's a primary catalyst here. Basically, in the past, when the Fed has gotten a bit too aggressive than what the market likes here, in other words, when they get too hawkish, there tends to be a lot of volatility that ensues, but ultimately, over the next few days, the market heads lower. And so this time, also yesterday with all that volatility going on, with the up-down action, it's almost like the system's becoming more unstable rather. It's destabilizing the system. So, today's action is not so surprising given yesterday's volatility.
Yeah, so what that sets up then, if the market is going to move on news that the Fed is hell-bent on raising rates in June and July, which personally, as far as the economy goes and in terms of trying to bring things back to some sort of normalization of interest rates, to me would be a good thing for the economy and affect in a positive way a lot of financial decision-making or business decision-making. Now what it does to stocks, I suppose you let the stocks tell you, but typically it's taken, 3 interest rate increases for the market to tank after a bull market. This is not your grandfather's bull market, however. It's a bit different, and we've had 1 interest rate increase, so another one, based on the rule, would tend not to kill the market. But in this market, I think anything can happen, and you basically just keep a real close eye on what individual stocks are doing. You maintain maximum flexibility. You keep your mind as open as possible at all times without getting fixated one way or the other. Even when you're making big money, short or long, I think you got to keep one eye, looking over your shoulder for potential failure. And also, I think some things that are long plays for a period of time can turn into short sale plays in this market, because we are in something of a range-bound market where stocks, even in uptrends, will go up a certain amount, and then they'll pull back hard. And sometimes, the pullback after some strong action, like remember Under Armour, gap up move here, and this thing just blew to pieces. So that was a beautiful short from there. I think part of this was due to the fact that they issued C shares, which I was wondering whether that's a problem for Facebook. But again, Facebook, it could be played, long for a few percent up to the highs of the range. But like I pointed out last week, it was wedging. And you can see that action in the volume from here to here. What color is it? You can't even see that. Let's get a nice color here. How about this? Nice blue color. Doesn't clash too much. But you can see the volume overall is just kind of declining as this thing's moving higher. So you get this break to the 20-day, rather, the green line here. And that can be viewed as a corrective, helping to correct this wedge. But in this case, there's a two-sided way to look at it, and this is how I will look at it, because I'll look at anything. If it's pulling back into an area of support at the 20-day line, yeah, I'll look at buying some Facebook. And I bought a little yesterday because it held the 20-day line, and volume picked up ever so slightly relative to the prior day. You can see that here. And then today we're busting the 20-day line on volume that I think is running above average right now. Let's check this out real quick. Yeah, it's running 31.5% above average as of 15 minutes ago. It might be 10-15 minutes delayed. So now what are you looking at now? If we know that a breach of the 20-day line, for those of you who've read and studied short selling with the O'Neill disciples, the hallmark of any late-stage failed base is going to be, or the first clue is going to be, a break of the 20-day moving average. I talk about this all the time. So that's how you know. You're looking at the pullback to the 20-day. If the 50-day was higher, or above the 20-day, then I would use that. But in this case, the 20-day coincides more or less with the top of this base, and so as it busts through, that becomes problematic for the stock. And I think at that point, it's starting to lean towards becoming a late-stage failed base short sale setup. And if we look at the weekly chart, we can see it's had a long run. This is kind of a faulty base, and probably from here it's headed for the 50-day line. That's what I would say, just offhand. So somebody has made a comment that I'll just point out. Scotty, I see your brain is whirring as usual. You must have had extra coffee this morning. Is that it? Interest rates cannot normalize. The Fed is in the corner. All the smoke and mirrors of QE have artificially inflated stocks and other assets. Time for crash helmets. Okay, I can go with that. I mean, if you think about it, I think near zero interest rates is one of the reasons why I think raising interest rates would be a good thing. But the Fed may be painted into a corner where they're not going to do anything but talk about raising rates and ultimately end up going to negative rates, which I think would be a disaster. And I think hasn't worked for Japan, has it, Dr. K?
It hasn't worked for any of the countries that have tried it, including in the European. It's kicking the can down the road even more so. But now the can is full of nuclear material, ready to go. Ready to go critical. So.
Anyways, so that's one to keep an eye on. And at this point, I consider Facebook a short using the 20-day line as a real quick or very tight upside stop, less than 1% away. So that's one way to come in and test it. And when I do something like this, I'll hit it short. But if it stops me out, I'm going to stop myself out if it gets back above the 20-day line. So I won't let it get out of control. But that's how I'll test things and not be afraid if it doesn't work. A lot of times people don't want to take a trade, especially in this market, because they're afraid that it's just going to whip on them. But the best way to handle that is to always have a close out point. And I think that's really the only way it works. And you got to be willing to bail out. But if the thing turns around, if it goes back above the 20-day and pushes you out of a short position and then rolls back below, then you may be right on top of it once again. And I'll do that too. I don't have a bias against buying and shorting and covering stocks several times before I catch a move any less or any more than I do buying and selling, trying to catch an upside move. So let's see. Somebody says, oh, not enough coffee this morning, Scotty? That's terrible. Verbal easing. Just keep talking about raising rates. I like that. That's basically what they do. Go ahead, Dr. You were about to say something brilliant.
Verbal easing sounds like a laxative. And, this whole debt that the world has never been in so much debt. Let's say in the last 100 years, it's a new thing for contemporary times. But the problem is that when you have all these countries in debt, and of course the U.S. has manufactured a lot of that debt that is owed, you can't hike rates. If the Fed were to actually hike rates by anything meaningful, these countries that owe all this money would have such an enormous interest rate burden placed upon their shoulders. It would completely destabilize those countries. And if you start destabilizing these countries, it is a house of cards. And that's not good for anybody. I mean, you need these countries. Everything's interconnected more than ever before. And so what we have on our hands is an incredibly fragile system that is, it's the furthest thing from robust, or shall we say anti-fragile, from Taleb's book. We're the opposite of anti-fragile. The world has painted itself into a corner with all these laws and rules and regulations and financial maneuverings. Therefore, I don't think there's a very good resolution to this story except a collapse of sorts. That is probably due sooner than later.
Cool. We need a little excitement. Things have gotten just too boring, right? Anyway, so Facebook, we could probably put out, hey, Dr. K, you could probably put out a short sale setup alert that Facebook is a short sale here based on the break of the 20-day line. However, you might want to see it bust these lows, but to me it looks like if the market heads lower, this turkey's going lower. So you'd use a 20-day line at 116.90, yeah, as a stop. Very tight. Anyways, somebody says WMT is a poster child for market volatility. Well, I think if you shorted it up here, you made money, but I also think that if earnings were going to be announced this morning, you'd be gone. So very playable. So, but it is pretty choppy. But there are places to hit it. You just have to be persistent. I mean, that's the other thing about the short side is that it requires tremendous persistence. You almost have to be a maniac. And even the long side has kind of become that way. You can't make money buying stocks and sitting there very long. Speaking of which, let's go through more of what I'm looking at here. Here's another one I thought is a short. Now, this one moved up with CRM this morning. Ran right into the 200-day line. I'm short this thing, so I hit it right there. And it's starting, well, it's come in a bit. It was in the red. Now it's a little bit in the green. But to me, that's a short using the 200-day line is a stop. CRM, I also shorted this one, and here's why, and I'm short it right now. It gapped up in the morning, and you know, what makes a viable gap up a shortable gap up? Well, in my book, the 620 does, but I'm also ready to back away from it, because I did that the other day with NVIDIA. I tested, I think, when did it gap up? Let's see. Might have been this day. When was it? Was this the day it was? The 18th? No, that was yesterday. And was this day? No, it was this. Let's see. I'll show you guys. Yeah, this was probably it. But you had a cross here, so I'll test that out, and it didn't work, so you just run for cover, and it actually never gave a 620 sell signal. But if you look at CRM, this is qualitatively different, because it gives you a cross on the MACD early in the day before the opening. And my charts, you can see that we have after hours trade in here as well. So and you have the MACD cross down here and the moving average cross here. So above 82, that's why I thought it was a short, and it's headed lower since then. So, you know, the news is wonderful, but when you're looking at a pattern like this on the weekly chart, and first of all, we know that stocks will top when the news is the most wonderful, right? I think, didn't Apple have a blowout quarter when they hit 130, and that was basically all she wrote? CRM had a great quarter, but this is right up to the left side of this very V-shaped pattern. So in my mind, probably what this big move is doing is discounting the fact that their business was doing pretty well. And so this is all in the stock, and I think all the good news is in the stock. So this is where they sell into the news. And the only confirmation you can get of that, if you're alert to it, is what happens on the 620. Now, if I went short this thing and it turned around and flashed a buy signal, well, guess what? I'm gone. And I may come back to it later. But I don't sit there. I'm willing to test things, but I don't sit there letting it push me and push me and push me until I'm lost 5-10% or something like that, because that can happen to you on the short side. My view is if I can always stay within 1-2% of my peak account value, in other words, limit the risk in a position to 1-3% max, then I think I'm doing okay. And that's just me. But if I can keep it to that minimum damage, and it doesn't cost my portfolio maybe 1% or 2% max, and I can live with that. So anyways, so that's, you know, that's what I'm looking at here, and it's heading lower. We'll see. But now is another perfect one. Another V-shaped type thing after getting blown apart. And these things should go down a long way. So I'm trying to decide if I want to hold a core position short in now or CRM, right? There's somebody on Twitter the other day telling me that CCL is a core position given the demographics, which I thought was really bizarre. I mean, to me it speaks of a completely different way of thinking about the stock market than I do. Because to consider something a core holding, like, what does that mean? To me, a stock can be a core holding if it's moving in the direction I want it to move. If I'm long it, it's got to go up, and I'll just hold it. And if it's going down and I'm short, I'll try and play it continuously on the short side. That's how they become core holdings for me. But the idea of a core holding is something that is the rock solid foundational center of something, like the core of the earth, for example. I think you're just a moron if you play by those rules. You know, well, this is a core holding, and what do? We hold it through thick and thin. I mean, these are non-performing stocks, both this one and RCL, Royal Caribbean. You have the huge break, and undercuts all these lows. Okay, that sets up a logical rally. V-shaped move. Now it's starting to break down. It looks very pod-like to me. And I would call it a baby pod. You know, baby pod maybe is 20-30% deep. A really adult pod would be 40 to 50%, I think. But, you know, it's all just labeling it. The basic idea is that you get a sharp break followed by a sharp move back to the upside, and it's unsustainable. Eventually what happens is you run out of gas. You know, it's just too sharp. It needs to either consolidate for a period of time before it can go higher, or it's subject to failure. Right now, this thing is looking like it wants to fail. It's not entirely conclusive, but you play it as a short by hitting it right here yesterday at the 200-day line. And there you have it. So, you know, pretty simple. Let's look at RCL. Hovering along the 50-day line. But, you know, you're telling me, this looks like a giant, you can see left shoulders here. Let me draw it for anybody who's visually disadvantaged. Here's a big left shoulder, a giant head where you have the big volume, break on the right side of the head, you see that, and then a right shoulder. And now you're running into resistance around the 10-week line. And that's pretty basic. Just looking around at my positions here. It's still pretty choppy. We're down 155. You know, if you're short, you're wondering whether you take profits here and back off and wait till later in the day just in case they have some sort of random rally, which I've seen happen. But I got to think that with the indexes breaking support, which is what you're seeing over here. Get back over here. I mean, they're testing supports. They're on the verge of breaking. The S&P is actually breaking support on the lows along, I'm going to say the 2040 level, and it's probably headed for the 200-day line. So it doesn't look happy. And you know, some people will point to it looks like you see a little head and shoulders, a fractal head and shoulders. I don't really use these on the daily chart, but in hindsight, you may go back and look at it and say, oh, look, that was a little head and shoulders formation. Or maybe you were looking at the weekly chart and it looked like this. And you'll say, oh, this is a giant, you know, rolling top head and shoulders type thing. Two-headed hydra with shoulders. I don't know. And in this market, a hydra probably is a typical pattern. Let's see. Any more brilliant questions out there? No, just some commentary from the gallery. Okay. Let's see. I mean, there's so many things that look ugly here. Oh, Workday is another one. They came out with earnings, I think, next week. But you can see this one's another one you could short. It rallied with CRM this morning, and it's reversed at the 50-day. So that's a short there. And again, similar situation, a big break, a V-shaped move. So very, very vulnerable to some serious downside, in my view, from here, especially if you get into a bear market. Let's see. Here's another one I shorted this morning. It got up close to the 50-day once again. It likes to do this on a regular basis. You hit it every time, at least for the last 3 weeks. Every time it hits the 50-day, I short it. It comes down a buck or so, and I cover it, and it goes back up. Eventually, I think this thing's got to blow apart. Here's the pattern. Remember, we talked about this last week. You got 1, 2, and a third base since coming public. So this is a third stage base. It could be viewed, if you like to put labels on things like this, it could be viewed as a late stage base on the verge of failure. But I would say here, you see where you have the breakout attempt, and we put this out as a pocket pivot here, which, you know, shows you how smart we are, I guess. But in this case, it was legitimate, and you know, on that basis, we're going to put it out. But if you're playing this, as soon as it gapped down, and that's about a 5-6% gap down from there, you got to be gone. And they come out with a secondary, I think. And if you didn't sell there, I guess you could have sold on the rally. But in any case, that just failed. So, you know, you take a shot and it doesn't work. But probably there were a lot of flaws in this based on the fact that it is a sort of a crappy looking pattern when you look at it on a weekly chart. That doesn't look very healthy. So we're down 175. You see, they're trying to rally the market, and it can't rally. So we almost, what do we get down right now? Like minus 140 something. I don't know why I always look at the Dow, but I do. I'm as bad as the media. But in any case, this looks like it's ready to just blow to the downside. So at some point, I'd love to just, and I don't have to have a huge position. It's kind of a thinner trader. So, you know, 5,000, 10,000 max would probably do it. For somebody trading a smaller account, a couple of thousand shares is very manageable. And I think you could hold it looking for a move down to the February low at 24. You know, we might get that eventually. Your first point of reference, that would be an undercut of this low a few weeks ago, 3 weeks ago or so, 2-3 weeks ago, say. And it undercuts the 28 low there, roughly the 28 level, and then tries to rally back into the 200-day. So there's probably a way to work it, but I think it's probably headed back to 24, maybe lower. So, you know, I'm watching this silver wheaten, and it's rallying off the 50-day line, but gold is trying to hold the 50-day line, the GLD at least, and silver is trying to hold the 50-day line. So you see SLW holding the 50-day line, but here's my thinking, and we've already talked about how the metals tend to act. They become sort of a safe haven initially, but the market gets into trouble, everything starts coming down, whether it's a core holding or it's a precious metal. as that represents gold or silver as an alternative currency. Maybe we run into something unusual where they keep rallying because things get so gnarly, and people need a safe haven like real gold or silver, although I don't think an ETF is going to cut it. I think you need the physical. But in any case, the rally off the 50, I'm wondering whether this becomes shortable. So I put out a little bit here, but I'm not so we'll see what happens. I'm trying to find my 620 chart. Has anybody seen my 620 chart? Where did it go? Hello, where are you? There it is. I think it's under there. I see it under there. There it is. Yeah, so here's silver wheaten. The MACD's starting to slow down a little bit, so it might possibly, and you're right at the 10-day and the 20-day, so it might possibly roll over. But I think what happens is you need a liquidity crisis to create selling across the board in all asset classes, and then that would bring gold down. So now is, let's see, now is running flat. You guys are all shorting it for me? Thank you. Keep shorting it. CRM pushing lower too. Let's see what that looks like on the... So anyways, I'm watching this. If I get across here, then I may go ballistic on it, but I don't know. We'll see. My thinking is it's rallying, yes, as a safe haven, but I don't know how safe that safe haven ultimately is. Anyways, CRM is just hovering along the lows, trying to find some support down here at 80.31. So interesting. Facebook, we'll follow up with Facebook, but you can also see early in the day you got a 620 sell signal on Facebook. I actually came in long this turkey, so I'm out of here fast right at the opening, and it actually opens mostly unchanged immediately on the bell, and then plummets from there, and then you get a 620 cross, so it becomes a short there. And this thing's looking grim. Looking very grim. I think it's definitely headed for the 50-day. So again, that's shortable using the 116.99 20-day moving average as a very tight upside guide. Less than 1%. You really can't ask for more than that when you're trying to keep your risk in control on the short side. PayPal, somebody's asking about. I have no position, but curious, where would you look for a potential undercut and rally or highs of previous blah, blah, blah? I hope you're looking at this as a short. So, well, it's undercutting this low. So, you don't know. You're undercutting, okay? Then you don't try to stamp a label on it that it's going to cause a rally, because it may have to undercut these lows first. What I do when you're coming, so let's look at this. You're undercutting this low, okay? So what is that low? 37.87. You're 3, 4, 7 cents below it. Okay. So here's what you look like on a 620. Right now, you've had a MACD cross off the lows, but the thing you're noticing is that there is no move above the 20 period. If I get a MACD cross like this and the stock moves back above the 20 period, I might cover it. Otherwise, I would sit with this short, waiting to see what happens, because all that's going on here, and you're seeing on an intraday basis, you're not seeing volume dry up. You see these, let's try and make this a little bigger. I think this is pretty instructive, because this is how I use the 620 when you're undercutting a prior low, because you don't know that it's going to rally. So I know if you've been brainwashed by IBD into thinking you can run around with a bunch of rubber stamps that say this or that or the other thing, and you stamp something with it, then that means you don't have to think any more beyond that. But that's not really how the stock market works. In this case, you can see intraday volume is actually picking up. See this? This is picking up. And you're holding in this sort of descending wedge sort of thing on an intraday basis. So it's either got to pop up through the 20-day and hold the MACD cross, which is now started here. I need to get a pen or something. Like, anybody know who John Madden is? He used to be the coach of the Oakland Raiders, and when he's on TV, he has the Madden, what do they call it? He was the first guy to use a telestrator, is what they called it. So, and he'd draw all sorts of cool stuff over instant replay. Anyways, I need something like that for the charts. But so that's where you are here. So you're in a position for an undercut and rally, but you're not rallying. Okay, so you don't need to assume that just because it's undercutting, it's going to rally. That probably depends on what the market does. So you want to also watch the market. If the market turns to the upside, then this probably is going to turn back to the upside. But right now, I think it's pretty well defined here. You have a MACD cross, but you're not getting any any real upside juice. Now somebody's standing here and buying it, it looks like, okay, but also somebody's selling it to him and it's not really moving. So how this resolves is probably going to be key, and my guess is going to break lower. So I if I had to guess, but I'll let the chart tell me. Like I said, if we get a move up through the 20 period and the MACD line holds in positive territory, then I'll cover. I mean, you can find another way. You know, sometimes I'll come in and I see something extended here, okay? So you get the MACD stretch right at the lows. You could cover there and then hang out and wait and see what happens and then re-short it if it starts to break. Or if it starts to rally, look to short it into the rally if it starts to give way. So I'm very flexible with these. I move around, but there's no, what are you looking for in an undercut and rally? Well, that's what I'm looking for. I'm not looking to put a label on it. So I hope that's helpful in understanding that it remains at all times a dynamic and fluid situation. It remains at all times an interpretive situation. You have to be trying to interpret what the market's telling you in real time. You can't slap simple rules on everything, So yeah, becoming a good trader is a lot of work, and it requires a lot of persistence, patience, and studying and trying to interpret what the market's telling you in real time, and also developing an open mind and being able to understand what it is that's happening, and then being open to a shift in signal. If you're going to sit there and be stubborn, that's a good way to get killed. And what I've learned over the years is to be much more flexible. And if I take a small loss, just get the hell out of the way and come back and hit it again. Because my experience is that, especially after year 2000, is that not controlling risk has been a weakness. And I pointed this out before because in the 1990s we were in a parabolic market, and you could screw up and the market would just keep going higher and you could make all your money back pretty quickly. You can't do that anymore. So you have to keep risk as tight as possible. And part of that means being extremely flexible and willing to just shift in a moment's notice. And that was Bill O'Neill's strength too. Somebody says I need the Gilmostrator, not the Telestrator. You're right. Anyway, so I hope that was helpful in terms of how you would interpret PayPal. So it's still an open question, and it could easily break to the downside. But I use the 620 when I see an undercut. So first thing I see is an undercut. And let's say I shorted the stock up here. I hope that's what you did. I hope you're not sitting here wanting to go long it. Because if you are, then I think I would just short it here. And it's interesting that most people seem to want to go long things. I don't know why. But it's like the old joke that the guy who gets a tapeworm and he goes to the doctor and he tells him, I have a tapeworm, and the doctor says, okay, well, tomorrow I want you to come back and I want you to bring an apple and a cookie. And the guy's thinking, oh, great. So the next day he comes back, he brings an apple and a cookie. The doctor takes the apple and he rams it up the guy's rear end. Then he takes a cookie and he rams it up the guy's rear end. The guy's thinking, oh, man, the cookie's not so bad, but the apple is terrible. And the doctor says, okay, tomorrow you come back and bring an apple and a cookie. And the guy's like, oh, great. So he does the same thing. Doctor takes the apple and the cookie and he places them where the sun doesn't shine. And the next day, he tells him again, tomorrow bring an apple and a cookie. So they go through it for another day. And by the fourth day, the doctor says to the guy, tomorrow bring an apple and a baseball bat. And at this point, the guy's really getting nervous because he's not so sure about the baseball bat, okay? So it comes in the next morning. The doctor takes the apple and puts it where the sun doesn't shine. And then he waits as he's holding the bat, and the guy's sitting there just bracing himself for the bat coming next. And at that point, the tapeworm sticks his head out of the guy's rear end and says, hey, where's the cookie? At that point, the doctor whacks him over the head. And so the lesson of that story is don't become a tapeworm in the market. So if you think that every time it pulls back, you're going to step in there and buy it, eventually you're going to get the baseball bat and not the cookie, okay? You like that? That's my market joke for the day. I can hear the tremendous amount of laughter out there right now. I think that was a joke my grandfather told me as an illustration of not to get caught up in expecting things. In any case, let's continue. Las Vegas Sands was a short near the 20-day. I think Google, we talked about this yesterday. It was a short at the 200-day. It already had become a short at the 20-day, which is what you were using previously because we put an alert out on this previously. And it's rolling lower. So at this point now, the 200-day becomes your stop. Amazon, this is, I think, another situation where you have a big cap leader. Okay, but let's take a look at this. Big move, but remember, here's this big cup. Remember, I've talked about this, the clown foot formation. So, in other words, and I talk about this in the latest book on shorting. When stocks get near their tops, they're generally pretty orderly on the way up, and you can see that with Amazon. And then as they get, so, you know, nice base. Whoops. Let me get my pen. I'm filling my Gilmo straighter. You got a nice breakout, a base, a breakout, base, breakout. And now you get into this big, sort of funky looking cup that's out of proportion to the other pattern. So like clown's feet, you know, so that's what we call it. And now it's also above the 700 level, but it's failing at the 700 level. So yesterday we put out a report stating that you could treat this as a short using the 700 level, which is still only a little over 1% away from where the stock is trading right now at 690 and change. Or maybe even because the high here, let's see, let me go to the daily chart. Yeah, if you're going to use a 10-day, it's close to 7, but you could use the high of 702.54. You could use a little bit more than that if you wanted to give it some room, because $7 is 1%. So if you're scaling your position based on percentage of your portfolio rather than number of shares, it's pretty basic. Well, whatever even your number of shares, your risk is a couple of percent. So in my book, like I said, 1, 2, 3%, that's the most I want to go. And so this is well within range. Now, the trick here is like with Facebook, which may be morphing into a short sale target because it's busted the 200-day line. Amazon may be the same thing, and it's busting the 700 level, and that's all she wrote, and it's going to top there. And, of course, the news is extremely rosy, as it was for Salesforce last night. And Apple at the top. And Apple, you know, let's revisit Apple here. That's a short here. You're probably in a bear flag here. There's the top of the range. It's probably going to break lower. Warren Buffett supposedly bought shares, but what I read is that it was actually a couple of guys he's hired who are going to take over for him when he kicks the bucket or decides to retire altogether, and they bought it. They also bought Yahoo, which to me, I thought, Scotty, I think you had a hilarious comment about that, that you told me that Uncle Warren has now discovered the internet, so he took a position in Yahoo. And I thought that was pretty funny. It's like, I don't think any of it matters. I think they're just buying because they're dumb. You know, Warren says he's never understood technology, and suddenly they do, and they're buying Apple just because they think it's cheap when it's in this pattern. I mean, you're basically hanging along the neckline, and I can draw it this way with the Gilmo straighter. Here's your neckline. To me, there's your neckline. You bounce off the neckline, which undercuts the prior low. It makes complete sense to me. And I've been looking for a rally. I was actually surprised at how weak it was after Buffett's announcement that they were buying, or Berkshire Hathaway's announcement, because it never got to the 20-day line. You can see it fell short, hit around 95 and change, and then rolled back over. And that was all she wrote. Let's see. Amazon is a baby pod. That's how I look at it. Because how deep? Hey, Dr. K, how deep are you? Actually, this is pretty deep. Is this 30% maybe? So it's on the verge of it's a teenager. It's a puberty pod. There you go. What is it, Dr. K?
Yeah, that's about right. It's you know, about 30% correction there.
Yeah. So that would be it's you know, on the verge of a baby pod becoming an adult pod. So we'll call it a puberty pod, 30 to 40%, okay? 15 to 30 is baby pod, 30 to 40 is puberty pod, and over 40 is an adult pod, okay? For those of you who like labels, so you can go on, what's that website where you can order rubber stamps for pretty cheap. Anyways, but let's see, I'm looking for more exciting questions here. There's really not very many, you know. You guys are really disappointing me. EGRX, Eagle Pharmaceuticals, that looks like a short. Only problem here is it's way too thin for me to play. So 425, 425,000 shares roughly. Let's see, Adobe. Yeah, this one, they come out with earnings in July, and we've talked about this because here's the main problem with it. It's very V-shaped. You're seeing stalling off the peak as it approaches, say, 97, 98 in that area. and it's doing it again, and the IBD featured this as a stock forming a flat base, and that's probably the kiss of death. So I'm watching this SLW. It keeps going higher, so it's not being very nice to me, but fortunately everything else I'm short is getting crushed. But it's getting closer. Anyways, Adobe, yeah, it could be morphing into a short, and it would be the same situation, and so you would be looking for a 20-day breach. You know, Workday started out that way. Let's go over to Priceline, which I think is a short as well. Yeah, and this was see how you break, you get the gap down through the 200-day, it rallies just above the 200-day line, but runs out of gas at the 20-day line, and boom, it's heading lower. Home Depot, we talked about this yesterday as a short, and it's hanging along. You know, it's undercutting here, so it looks like it wants to rally into the 50-day, but that's at like 133.36. So if you get close to 132.50 or higher, you're within less than 1% of the 50-day line. So it's shortable at that point. So, and it could bust. It's kind of a sloppy and not really very nice looking pattern. You can see the huge volume here on the left side of the cup here. So you got big volume in here, and there's really no volume. It's basically a big wedging rally back up to the highs, and as it fails here on the breakout attempt, maybe that doesn't look so good, that color. Let's try something there. Let's just go with black, yeah. As it fails on the breakout attempt here, the volume starts to pick up on the weekly chart, and then this week you're seeing volume picking up again. So this thing looks like a clear short to me. And you would use the 50-day line at 133.48 as a very tight guide for a stop. And that's 2% from here, I think less than 2%. Pretty tight. So maybe I'll short some right now. Yeah, that was what I was saying, Scott, on the SLW. It looks like it's finding support at the 50-day, and I guess the implication here is that they're not believing that the Fed is really going to raise interest rates. But then if that's the case, why is the market selling off? So not really, it doesn't seem to make a lot of sense, but you know, things don't really have to make sense. So yeah, they're pushing it. But this is what it looks like on the weekly chart. So it's running into a lot of overhead supply in here. And I'm not, you know, like I said, I think that if the market continues selling off, everything's going to get clobbered. So they're just going to end up hitting these. And it may not work out as a short today, maybe tomorrow. You know, you could have come in, you could have hit it yesterday. Actually, I did hit it yesterday, and it did come in on the day. And because, you know, they were basically telegraphing what the Fed minutes were going to say. I think all of the Fed heads were out ahead of that, and they were all basically trying to prepare the market for the minutes, and that's basically what happened. What is this here? Something happened. Let's just go back to, I must have done something there. In any case, so the Fed telegraphed it, and when the news came out, the market seemed to digest it pretty well, and then it seemed not to digest it pretty well. And basically held tight along support, and then today it's not, you know, it's not really happy. And so if the argument is that they are going to raise interest rate, and that's what the market doesn't like, then why is gold or why is SLW rallying? And I noticed, you know, GLD, the metals are not rallying. They're actually down on the day, and they gap down, but they're trying to hold the 50-day, both of them. So, you know, we'll see what happens here. It's still in play. Very small, so we'll see what happens. Where were we? Market overrated to potential rate hike. The Fed cannot raise rates. Yeah, so don't you think the market knows that? That's what I find puzzling. The market knows that the Fed can't raise rates, so why is it selling off then? Is it because it knows the Fed can't raise rates and that everything really stinks? And that the global situation is getting worse, and there's going to be a Brexit and a Grexit and every other kind of exit. What do you think, Dr. K?
Well, I think that the last 18 months are telegraphing to the world that things are getting worse. There is a growing loss of confidence. There's a number of metrics that have hit tipping points. Things, anecdotal stuff, but important nevertheless, like, the majority of people now do not trust mainstream media. And that's the first time that's happened. More of them are relying on alternative news sources. Much of this comes, of course, from the internet. It's just a breakdown of confidence, I think, across the board. I mean, the U.S., a lot of stuff in the travels I've had over the years, what I've noticed is that there's tons of information control within a given country. But when you go outside that country, there's a lot of information leaks. So a lot of stuff I hear about, what goes on, say, in the U.S., people in the U.S. have no idea about. The same goes for the U.K. Step outside of the U.K. and start to see things and notice things, because the UK is very good at information suppression. But this is nothing new. And I'm not trying to single out any one government. This is just the way things work. They've been this way for decades. If I'm appearing negative, it's not to be negative. It's just to be, this is reality. And I'm not singling out any country either, because it's the way of things. And so at the end of the day, we all have a responsibility to, there's no point in being negative. That's the first rule. Stay focused on, you always talk about it, go to the love, O'Neill used to say, go to the daylight, find the daylight. And I think the market allows many of opportunities for us to do that on a day-to-day basis.
So do you think the market's selling off because interest rates are going to rise?
I think this is the short-term correction where the market's nervous about the Fed's announcement.
So then why would precious metal stocks be rallying?
Well, there's a lot of cross currents with precious metal stocks. First of all, so a lot of these things we are not privy to on a day-to-day basis. But it could also be a combination of loss of confidence and that is keeping these trends moving higher. I mean, gold has been on an uptrend since December, and the markets have been rattled quite a bit over the last several months, and this is despite all the QE that is going on. So it's a combination. Perhaps if I had to guess here, it's that precious metals are signaling loss of confidence. The markets are heading lower in a short-term basis. I don't think the Fed is going to be able to raise rates. I think central banks have to keep printing all this money, and so that ultimately bodes well for equities and hard assets. So it could be that we see the market start to hit new highs in the many months ahead. That would not surprise me one bit, because ultimately this money that's being printed has to go somewhere. It's there, and it tends to find a home in equities. It's not a very pleasant scenario, because it just delays the inevitable. This can that's gone nuclear just keeps getting kicked down the road over and over again. But at some point, something's got to give. This cannot continue endlessly.
Okay, I was actually hoping for a shorter answer than that, but I'll take it. Okay, let's go to Tesla. This is another one we've had.
I gave you my short version.
Okay. Okay, Tesla we talked about back here when it tried to rally after earnings, and we put it out as a short sale setup alert, and it broke the 200-day, I think on one of these days, I forget, and busted hard. And since then, after it undercut this low here, and you can see that it undercut the low right here, which doesn't really set up much of an undercut and rally. You get this little move, and then you got this move yesterday to the highs of the range. Now, the interesting thing yesterday was that Goldman Sachs came out and recommended the stock, and then at the close, we find out that Tesla was issuing a secondary offer. I think it's like, 9 million shares? A lot of them are Elon Musk shares. He's a crafty guy. He probably knows it's time to bail. And Goldman is one of the lead underwriters, along with Morgan Stanley, which also put out a buy recommendation on Tesla somewhere in this bear flag. So now you can see the stock is in a bear flag, and so as we wrote yesterday, we just think the rally allows you to short it at the top of the range. And if you're using the high here, like 216 and change as your stop, I think you're about 4% less than that away. That's reasonable, but I think you had to hit it earlier today. And after hours after they came out with the secondary announcement, the stock broke to like 203, and then you saw it rally back. My guess is, if you look at it, and this is something I know about the institutional side of the business, the brokers, they're all slimy, okay? And they have ulterior motives in a lot of their recommendations. And a lot of it is to generate business one way or another. Now, if you've got a bunch of clients who want to unload a bunch of Tesla and you know there's a secondary coming, well, what do? You put a buy recommendation out on it. That's what Goldman did yesterday. That's what Morgan Stanley did, I think, a week or so ago, or a little more than that, say. And they're the other lead underwriter. So they're giving some cover to their clients to unload. And they'll tell them. I mean, we used to get calls, I remember, when they had the fund, and Bill told me this, that they would call, this is the New America Fund, and Bill told me they get calls from brokers saying, hey, tomorrow we're going to upgrade such and such a stock. Why don't you buy 50,000 through me today? So they can ka-ching, do some commissions, and then you get the pop the next day. And they would go around, telling people that, and that's how they generate business. That's what they're there to do, and they'll do it any way they can. And if they can move a stock with a recommendation, and they know it, but they pretend they don't, there are no Chinese walls anywhere, really, then they'll do it. And so, they're just setting this thing up, in my view, as a short sale yesterday. And that was the other one we put out. What were the other ones? We talked about Netflix. I mean, that was a short at the 20-day yesterday. I mean, this isn't a bear flag. It looks like it wants to go lower. So they're all over the place. The market looks grim. I mean, the patterns are just grim everywhere. So you can almost throw darts today. Facebook is flailing at 116.02. I think that's near the lows. Baidu's another one I looked at as a short, and probably should have put this one out. You get a breakdown through the 200-day line here. You rally back to the 200-day line, you're breaking. The 200-day line is 172 to 173 in there, and you're 165.91, so you're about 3-4% below. It looks like it's rolling lower, and that's what it looks like on the weekly chart. That doesn't look healthy. No matter how you want to twist it and hold it up to the light, it just doesn't look happy. I looked at CCL. I looked at some of these. Some of these other. Look at this one. We talked about this as being in a bear flag, and this is hard to see, but you can see it's failing at the 20-day. It was rallying with CRM. Probably splunked the same exact thing. Yeah, it gets close to the 40-week line on the weekly chart and the 200-day line here, and it's reversing. So, these are probably all going lower. I think CRM probably goes lower. How do you like that? Scotty, you're on a roll this morning. When was the last time we had negative interest rates on 40% of sovereign debt, you ask? I give up when? Never? Since before my life began? I don't know. I'm assuming probably never, at least not in any modern times, modern financial history. Maybe the Romans did that, but I don't know. Let's see. So, data, Splunk. What's that, Dr. K?
Specifically speaking, there's nothing in contemporary times. This is a brand new situation.
This is unprecedented. Yeah. So, anyway.
You have to go back through a long database, and you could go back a couple thousand years, and I think you see some remnants. Those are obviously relevant examples because they didn't end. None of these extreme situations ended pretty. Not one.
No. Yeah, and this one probably doesn't either. Here's Palo Alto Networks stalling out at the 20-day. That's a short, and here's what it looks like. Another one of these not very happy patterns. You see the rally off the lows in February really never went very far, so that's pretty weak. But I think if you're looking at the stocks we've talked about as shorts in the webinar, and you've built up a short sale watch list, I mean they're all over the place today. And I've just maintained an open mind about whatever happens in the market. I'm gonna go with the evidence in real time. I actually came in slightly on margin on the long side because of the way the market closed, and I was able to get out pretty much unched. I mean, now had a nice. Actually, I bailed out at 71 on that one, and then it kept rallying, and I shorted it into the rally. And Facebook, I had some of that, and I just bailed on it right away, and that was a short right at the opening. So you're flipping, in some cases flipping from long to short and doing that very quickly. I have no problem doing that. I can be short something I was long this morning, and I can be long something I was short this morning. I don't care. I have no bias, and I have no core positions. So I'm still marveling over that whole mentality. But do people realize how stupid they sound when they say stuff like that? Oh, this stock is a core holding. We must hold it no matter what, even if it goes to zero, because Nokia and Motorola were also core holdings in a lot of portfolios. Jeez Louise. Anyways, I think that's all I've got. You know, we've given you guys some good short ideas over the last week. I think you had to be alert to them this morning. I showed you some other stuff this morning, and it's come lower. Now is one example. GoDaddy, I think, is another example. You know, I'm showing you Palo Alto Networks. You might look at Nike, which looks like garbage, but that's another one. I've been working on the short side. This is getting a rally into the 10-day, so maybe, you know, it's a little extended to the downside, so it's entitled to a little bit of bounce. See how it undercut here, and now it's turning here, but this could run out of gas, depending on what the market does. Workday, we looked at now, Splunk, all of these things. Splunk is flat right now. I'd like to see a rally on some of these to short them again. That's what I would try to do if I got that chance in some of these. Anyways, that's all I've got, you guys. Hopefully you got some ideas here that are actionable, but I think you sort of have to be very flexible. And if you're a short seller, number one, you should have read both of the books that I wrote on the short side. The first one with Bill, the second one with Dr. K. And understand the mechanics of short selling. Always have a short sale watch list handy, and I've talked about that. You know, I've always got my list of shorts along with my list of long ideas handy, and I'm ready to move with things as necessary. And if you understand the mechanics of shorting and you have a decent short sale watch list, and I think over the last few webinars we've shown a lot of great examples from which you could have built a short sale watch list, I think you're in position to make money on the short side when things start to break down, and you can recognize it if you understand the mechanics based on studying the book that we recently published on the very topic of short selling. Anyways, that's all we've got for today, you guys. Thanks for showing up. We'll catch you next week. Have a great weekend.
So long, everyone.